The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we wrapped up the trade action on the day Wednesday, you look at quartered soybeans, fairly quiet, didn't move a whole lot on the day. We were down a little bit in new crop corn when it was all said and done. The wheat market a little more pressured there. Stock market relatively quiet. I know we have more inflationary economic data out later this week, and we also have a WASDE report in front of us on Friday for the grains. We got plenty to talk about here on the show today. Let's bring in our guest analyst. We welcome in our friend Mike Zuzolo with Global Commodity Analytics joining us today. Mike, good to have you back on the show. Hope you're doing well. It feels like it was kind of a consolidation type move, at least in the row crops on Wednesday's trade. Is that how you would maybe assess it just broadly today?
Yeah, I think we've been moving back and forth in tighter and tighter ranges, Jesse, heading into the WASDE report. I would frame this market, maybe broadening it out past Friday's numbers from USDA to kind of a three-legged stool, or three major factors that are probably going to carry us into harvest. WASDE's being one of those factors. I think another factor that has been more present this week than maybe last has been the continuation of the dollar bull story. The dollar bull story kind of fed this week in large part to a lot of economic data coming out of China. That data we can talk about if you'd like in a few minutes. But that Chinese economic data is weak enough that it's going to be really hard for them to get 5% growth. You and I have hammered this a lot in 2023. Now the rest of the market's seeing that, and it's brought back the dollar bull, especially against the Chinese currency and now other emerging market currencies, including the Brazilian real. So that's the second leg of the stool of factors, I think, that are going to keep this market driven in one direction or the other. The third is this global El Nino. You and I have also been talking about that. We've sharpened our pencil on this a little bit more. We've gotten more news out of China, how bad the northeastern China floods in their grain heartland has been, especially with the government diverting water into areas other than Beijing, into other farm areas. And so a bigger swath of the farmland is getting hit in China. India is also part of this mix with this global El Nino. Just today, we saw the price, the world benchmark price for rice in the whole world out of Thailand hit its highest level of over $600 a ton since 2008. And so global El Nino, WASDE, China fundamentals equaling a global recession. Those are the three legs, I think, of the stool that we're going to have to work through as we get closer to the northern hemisphere row crop harvest.
All right, well, let's break this down a little bit, Mike. We can talk WASDE and weather more in depth here in a minute. I want to stay focused on some of that China inflationary news. I'll pull up a chart on our video feed, and this is looking at China maybe being in deflation, looking at their CPI and PPI. Can you walk us through what you're seeing here and explain this train of thought a little bit more?
Yeah, I like this Reuters chart a lot because it overlays the CPI and the PPI, but more importantly, it talks about how consumer prices now, after Wednesday morning's update by the Chinese government, shows that consumer prices are now a negative. That's the first time since February 2021. That's the heart of the pandemic price action. And so we're literally suffering as much as we were during the pandemic on a consumer price level, with producer prices still down over 4% in the red. And this just screams deflation in the market. A lot of people in the market, I would agree with the idea, are talking about this Chinese getting more and more like Japan, where they're going to have to fight the deflationary trap for 10, 15, 20 years if they don't act rather quickly. I think this, again, wipes off the table the idea they're going to get a 5% growth. That means a lot of unemployment. And again, it goes back to the currency markets. Now, one thing I will stress, Jesse, this CPI number came in the aftermath of the export-import data the prior night. They both match up really nice in total. Goods and services, exports down 15%, imports year over year down 12% versus July 2022. And those are July numbers for China. Those are the broad goods and services numbers. But when you look at July soybean imports coming into China, they were up 24% or just under 24% at almost 10 million metric tons. So what I'm going to say here to the viewer today is we have a macroeconomic headwind and a dollar bull in the mindset of China weakening, but the grain market is still seeing very stout demand. And that's what's going to have to play out here in the next couple months. And that's why I think that global El Nino means so much.
Well, let's talk a little more on weather. And I know weather a big focus in the grains and oil seeds here. And I know thinking about just the weather pattern in the U.S., we've gotten more rain. We've turned a bit cooler. One has to wonder if some of that could get factored into Friday's August WASDE report or not. Mike, could you talk about that a little bit?
Yeah, I'm going to show you a couple charts that I use. I use about 12 to 13 different types of analytics to come up with a yield focus. And my yield number for 2023 corn is 173.1. My yield number for soybeans is 49.9. A couple of these maps are part of the reason why. I'll just say and go on record, I'm not sure USDA is going to see it this way, but I will say that with crop conditions very close to last year and the drought in the Corn Belt double what it was last year, I think we could expect the USDA to drop again like they did last year. Last year, July's WASDE report showed a 177 corn yield. August went down to 175.4, and then the final yield 173.3. So this is a daily crop condition soil moisture analysis done by the U.S. government using satellite data. It also includes vegetative data and crop analysis. This is at the subsoil moisture level. And so while this past week we've seen a lot of help in some of these very red and burnt orange areas that suggest, less than 40 and even and less than 70% of subsoil moisture versus normal, those topsoil levels have been replenished. But I would say if I look at Missouri, for instance, and last week, if you recall, Jesse, we looked at some ears from a Missouri farmer that sent some stuff in, and that area that he sent it in from was right around the Hannibal area and real close to the level of where we were in that darker orange area in western Illinois, eastern Missouri. And if you follow that on up, you see that most of Iowa and a lot of southern Minnesota and North Dakota, notice what that blotch of North Dakota and southeastern Kansas, all these areas and the southern half of Indiana, all suggesting, along with the southern half of Illinois, it's going to be hard to replace last year's yield or get up to last year's yields, even with this recent moisture. And I'm getting more and more feedback from clients in central Nebraska, where another brown blob is. That a farmer just sent me some pictures of his irrigated corn, had some beautiful ears, but he also had some serious tip back, and he also had some aborted ears as well. So that's why, in part, I'm down at that 173.1 level in corn, saying it's not going to be any better than last year.
Well, and I look at the state of Iowa largely cut in half with a lot of those darker shades there throughout basically the eastern third, northeastern Iowa. And you look at just the drought severity in Iowa. This is another chart you sent me. That has me a little bit concerned here as well, Mike, about what we could see for a final yield, because Iowa's such a key player.
It's going to be the key, along with Illinois and Minnesota this year, because we know that east of the Mississippi River, it's going to be really good. I talked to a client near Kokomo, Indiana today, and he said he's going to probably have the best yields ever if he gets more rains and doesn't have any disease pressure. I've heard that from clients northwest of Lafayette, Indiana as well. It's just the southern half of these states and east of the Mississippi River that are so important. But Iowa, I think, is going to be the make or break for that 175 plus yield. It typically is anyway. Illinois and Iowa have to almost always come in strong to be able to get above 175, if you ask me. So if you look at this drought severity map and coverage index that's put out by the government, we're at 217 as far as drought severity versus a year ago on this exact same date on the 9th of August, we were at 122. So again, that shows you we're double in drought severity in the state of Iowa than we are at this point in time last year. So and I have to make a correction that those tip back years that we looked at were from Waterloo, Illinois. That was just across the border from Missouri, south of St. Louis. So just to give you a correction on that.
Well, we're having a conversation today with Mike Zuzolo from Global Commodity Analytics, and we're working through the week and working towards that WASDE report on Friday for the month of August. How are things looking chart-wise as we head into that WASDE report? You know, Mike, I think about December corn, $5 has been a psychological level, kind of a bottom, so to speak. Whereas soybeans, $13 November beans has kind of been our psychological level there. I mean, realistically, let's start with December corn. Is that something that we think we could stay around $5 here? What are you seeing?
Yeah, I think we need to, Jesse. I think this is a December corn chart, and it's a continuation. It's a monthly chart of only December futures. So it really takes out a lot of the noise, a lot of the spread activity. And those two flat lines, one purple, one light blue, those are my value levels. I'm at an undervalue of 495. That's where I've got livestock feeders buying more. At 620, that's where you want to start hedging. That's where we hedged several weeks back and did an increment for the first time on our 2023 new crop corn. But you notice what I love about this chart is, and what you just said about that 490 area, if you look at the May low, the June low, the July low, and so far the August low, 480 to 490 catches all of those lows. And it's really interesting to see how we are indeed consolidating around that area. And that makes sense because USDA's average cash price is upwards of 480. And yet if you take a 30 cent, 35 cent basis off that 490 futures price, you're down at a 440, 450 cash equivalent price. And so we already are well below the USDA average cash price as of last month and a 2.2 billion bushel carryover. So between that part of the chart and also how oversold those stochastics are, the red and white lines at the bottom, we've been oversold since the second quarter on the fast stochastics, and now the slow stochastics are every bit as oversold. I would suggest that the technicals, if you didn't care anything about fundamentals, the technicals would say it's going to take a lot to get new sellers into the Dees corn market. So that's where the report comes in. That's where the dollar comes in.
Same question on soybeans. Let's look at the November soybean continuation chart. What are things saying to you when you look at the chart signals and the stochastics here?
Yeah, a lot different. You notice that we've been in a buy signal for the Nove beans. That buy signal was accurate. We had a very strong move up in the month of June. We closed at the highest in 3 months in the month of June. We're still trying to hold on to that price action. A major support, as you say, is the 1290 area. That's not only a 38% retracement line on this chart, it's also right around the 100-day moving average in November beans as well. And you notice we're back to where that apex is, where the point of the wedge in orange is. So this is why I've been, both with fundamentals and technicals, more eager to hedge and roll up puts in soybeans and really kind of sit on the sidelines and sit on my hands when it comes to corn. So if I just looked at both charts and thought about only the WASDE report, I think it's still, even after this pullback from $14.40 down to $13, I still think we need to feed the bull in the report for the soybeans unless we turn off hotter and drier again. And then the beans could lead us regardless of essentially what the WASDE says, I think.
Mike, before we go to livestock, you and I haven't even talked about wheat yet today, and we should at least say something about wheat. Feels like kind of the same storylines, waiting to feed the bull with what's going on in the Black Sea, and then also, you know, some worries about production issues in the Northern Plains and Canadian prairies. That seems to be the two biggest things in front of me when it comes to wheat. And then also, I guess I'll throw in there three biggest things, the dollar bull that you mentioned earlier in the show as well.
Yeah, I think that's that one and the spring wheat issue really got overshadowed by the Chinese economic data,
Yeah.
and also the news late on what been Tuesday afternoon that USDA was going to reevaluate the acreage base in things including wheat. And I think the trade took that as we could have bigger wheat acres, whether it's bigger soft red wheat acres or whether it's bigger spring wheat acres. I don't think they liked hearing that. And I think that was part of Wednesday's mix. But the supportive part of the wheat, I think, and this may not show up until a week or two down the road, Jesse, and this kind of goes in line with that global El Nino issue, is Egypt booked wheat from Russia this week. It was a good amount. And more importantly, it was around $260 to $265 a ton. We had been thinking in the trade that Russia would have a floor price of 240. They wouldn't want to sell anything underneath that. Well, that floor price was $20, $25 higher. That's supportive, I think. And I think between that and that rice price in Asia making its highest move since 2008, these things are supportive features to the wheat complex. But it was clear the dollar bull was not able to affect the crude oil market as much thanks to Saudi Arabia, but copper and wheat, I think, really did take a hit and lose some potential new longs from coming in. So that's where those world stocks to use ratios on Friday's report probably mean the most. If I had to guess, if you're going to jump into wheat, you don't want to go over 30 or stay over below 33% stocks to use ratio would give them a reason to jump back in, because that's where we were, about 33.3% on world stocks to use on the July report. And if we don't add too much Russian, Ukrainian supplies, then maybe those longs will finally step in.
All right, Mike, let's talk livestock. And I know we want to talk a little bit about just the ongoing relationship between equities and these livestock markets, particularly in cattle. Walk us through this chart first. What are you seeing here with this relationship?
Yeah, real briefly, cattle look most susceptible to me, Jesse, fundamentally between the seasonals and the equities and the hog markets, and seasonals and hogs as well. But the equities markets, I've got three orange squares and one white square on this chart. This is the S&P 500 weekly chart. You see a pretty substantial reason to be fearful. We're going to at least have a pullback in the month of September or October in the equities markets, because that tends to be a very strong seasonal during this time period. And that makes sense because we don't have a Federal Reserve report. So I think this is where that CPI number you talked about, which is coming out on Thursday, really is important to the trade. And the reason I think this is because that orange wedge and that major 200-week moving average are coming together around 38.50. And the only thing really holding us up is that very narrow uptrending channel in purple. So if we take that uptrending channel out in purple on the support side, I think we could fall all the way back down into that apex of that orange wedge and also that 200-week moving average and make a similar break as what we did last year at this time of the year.
Well, and I know as well, if you look at lead month live cattle futures with the S&P 500, there's some correlation that you're seeing there as well, isn't there, Mike?
Yeah, and this is why I threw this in, is because, it's a pretty big stretch for a lot of people to say, why are you talking about the stock market and fat cattle at the same time? Well, this is why, because if it was a negative correlation, I'd be talking about it. But since it's such a strong positive correlation, you really want to keep your eye on it, especially if we see a belly top in the seasonals for the BLT, which is coming in, I think, right about now. This second week of August tends to bring the BLT seasonal to a close. The other thing I'd say, Jesse, is we really are kind of on borrowed time with the summer grilling seasonal, because packers should really be jumping in at this point to take on the Labor Day purchases at this point. And I don't like the fact that the packer margins are negative $70 plus in beef, whereas they're positive $17 in pork. So I see some headwinds fundamentally in the cattle. Feeders, it's interesting because I see more headwinds in the technicals because we couldn't take out 250 in the August feeders, and we've got gaps below the market at 235 and 231. And those August feeders go off at the end of the month.
Well, and to your point as well, cash trade the last couple of weeks in cattle country, I've been scratching my head at it, Mike. It just doesn't seem like it's perplexing to me that there's not much movement out there in feedlot country.
Yeah, and I think Thursday, Friday, we need to see some really strong, decent movement and see a better kill than we saw this past week, which I think was down almost 1% if memory serves me.
Well, Mike, great thoughts and analysis as always. If folks want to reach out to you, take a look at your analysis, I know they could do that very easily online. How can they get a hold of you, Mike?
globalcomresearch.com is the best way to go, and toll-free numbers on there, product services on there, and sign up for that trial as you're talking about. There's just 3 questions you answer, and you get two free weeks, and then I'll contact you once. So globalcom with 2 M's, research.com.
Mike Zuzolo, Global Commodity Analytics. Always great to talk with you, my friend. Have an awesome rest of your week, and we'll talk to you next week.
Thank you, Jesse, and thanks to all the viewers out there.
And that's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.